Hello and welcome to topic 45, income taxation of trust and estates. This is probably some new information for you because trust and estates are not readily covered in several income tax courses, so we're going to dive a little deeper into both of these. First, what we're going to do is discuss general issues, who the grantor is and what are non-grantor trusts, discuss the differences between simple and complex trusts, what are revocable and irrevocable trusts, talk about trust income and estate income taxes. So there are general issues of non-grantor trust and estates. So there are filing requirements and deadlines. So for a trust and estate, now you have to know that it's Form 1041, also due by April 15th, similar to individual returns. You have a choice of a taxable year, but you must use a calendar year unless the trust, the non-grantor trust or estates are tax exempt, charitable, or a grantor trust. So if it's a grantor trust, you have to choose you must use a calendar year. Otherwise, you may have a choice. Estates may choose either a calendar or a fiscal year. So trusts are a bit more regimented. Now we have distributions to beneficiaries. They are taxable if they are not part of the DNI, and DNI we'll talk about a little bit later, but just understand that they're taxable if they are part of the DNI. Then we have a rate structure. This is a bit more complex tax rate structure. So then we have grantor trusts, and now this is a trust that's established by a grantor where the grantor is deemed to be the owner. So here the grantor is the owner for income tax purposes. So in this case, we have grantor equals the owner. And then the grantor reports all of the trust's income and expenses on their individual tax return. So basically this goes to the individual tax return. So if it's a grantor trust, the grantor is kind of deemed the owner, and then that flows, all of the income and expenses flow through that individual's tax return. But with a grantor trust, you have tons of powers. So these are the powers that, if held by the grantor, will make a trust a grantor trust. So some of the most common is if the income is paid to the grantor's spouse, for example, or if the trust income may be payable to the grantor or his or her spouse. So also if there's accumulated for future distribution to the spouse, that's all, will make the trust a grantor trust. Those are some of the most common. Also, if you used it to purchase life insurance where it goes to your spouse. So usually it's mostly dealing with income, as you see here, and then the trust principal returns to the grantor or his spouse. So those are probably the most common, and the grantor retains the right, the power to revoke or amend the trust. The grantor can dispose of the income at less than full value. Those are less common. Mostly, I would say the more common in industry is what happens with the income. So that is what we're really concerned about, and mostly it becomes a grantor trust if most of that income is going back to the grantor or the spouse. Then non-grantor trusts is just simple and complex trusts, right? So anything that isn't a grantor trust kind of falls into this catch-all of non-grantor trusts, and those can be simple and complex. So a simple trust basically distributes all income to the beneficiaries annually. So that's simple, right? So you take all the income, distribute it annually to the beneficiaries, and capital gains are generally not considered to be income. So that's a key here because that's a big misconception in the CFP exam. So make sure that you note that even though it's a simple trust, capital gains are not considered as part of the income. So then the trust income then becomes taxable to those who it's distributed to, which is the beneficiaries. So simple trusts just don't accumulate any income, and there's no standard deduction at the trust level. There's only a $300 exemption, and that's usually for just some filing fees. Complex trusts, now this gets a little more complex as the name suggests, and here the trust is not required to distribute all income annually to the beneficiaries. Again, capital gains are not considered income. Don't forget that, because that's a common misconception and one of the questions that you might get wrong on the CFP exam, so we don't want to make that happen. And then the trust income is taxable to the trust if it is not distributed. So now in this situation, a simple trust, we had everything go out. All the income go out to the beneficiaries and they were taxed. Now, in a complex trust, if it is not distributed, then the trust income is taxable to the trust. And you can also accumulate income in the complex trust. There's no standard deduction at the trust level. There's only $100 exemption. So this is usually done if you have quite a bit of assets and you're trying to accumulate that and have the money keep building. So in my experiences, I've seen more complex trusts as opposed to simple. Simple trusts don't normally always meet the needs of the people that want them. Then we have revocable and irrevocable trusts, okay? And so basically a revocable trust, it provides that the trust can be revoked or changed by the grantor at any time. So if it's revocable, it can be changed by the grantor at any time, and a revocable trust must be a living or inter vivos trust because the grantor must be alive in order to exercise the power or revoke or amend the trust. So the grantor at the time obviously has to be alive. Then after the grantor's death, a revocable trust then becomes irrevocable because then no one has the power to revoke it. So basically, if it's a revocable trust, the grantor has the power to change it at any time as long as he is alive. Once the grantor is no longer alive, then that becomes an irrevocable trust. Then you have trust income, and we mentioned earlier DNI, distributed net income, because you know that simple trusts distribute all the income and complex trusts don't have to distribute all the income annually. So you have trust accounting income, then you have what is taxable income, and then you have distributed net income as well. So your trust accounting income is pretty much income minus expenses. They do not include capital gain. So this is pretty much like your net income for the trust, right? Revenues minus expenses equals net income. Think of it that way. That's your trust accounting income. But now your taxable income takes those income and expenses, and now you have income distribution deductions. And so those income distribution deductions are removed, but this one can include capital gains. So they're not included in one piece, but they are included in our taxable income piece. And then your distributed net income is the maximum amount of income that can be taxed to the trust beneficiary. And here we go through an example. So what if we have these deductions for a trust that distributed $10,000 to the beneficiary if the trust had $5,000 of interest income, $2,000 of dividend income, and $4,000 of long-term capital gain, right? So the interest deductible deduction that we can take is $7,000, $5,000 of the interest income, and $2,000 of the dividend income. The remaining $3,000 is a tax-free form, right? Because we don't take that. So just kind of make sure you go over that. You'll get plenty of examples of this in your homework as well. And then you have estate income taxes. And so right here you have the income that you earned during the administration of the estate, and that will be taxed with the complex trust rules. So is an estate is taxed at the complex trust rules, except estates get just a $600 exemption. You'll remember it was only $300 for complex trust. So now it's $600 for estates. And the estate can also have an IDD for the income distributed to the estate beneficiaries. Now, the administration expenses may be deducted either on the estate's income tax return or on the estate tax return. So that deduction can be taken one or the other, but not both. And that concludes our discussion for trusts and estates. Make sure that you definitely have the various forms of the trusts, like revocable and irrevocable, simple and complex, and estates, and the exemptions and what are allowed. And make sure you include those in your notes. Thank you.